Is the office party over? The pandemic and shutdowns completely changed our approach to work, with businesses quickly leveraging technology to enable workers to operate safely by working remotely and, in the most part, very efficiently. Many of us are now back in the office, enjoying face-to-face interaction with colleagues, clients, and teams, whilst others are still firmly entrenched in their home office. The remote working experience raises a burning question. Is working from home a short-term pandemic trend, or is it set to become the norm over the long term? And will it lead to less demand for office space? Thanks for joining us today. My name is Simone Newman and I head up distribution at APN Property Group. With so many businesses still working their way through flexible work culture, the uncertainty around the future of our office towers is the most pressing question we're being asked by clients. I'm joined here today by Portfolio Manager Mark Mazzarella, who spends his working days in the office analysing the office sector. Today we'll delve into the key questions regarding the future of office space to find out whether the party really is over. So thanks for your time today, Mark.
Pleasure, Simone.
Let's jump straight into it.
Sure.
The concept of flexible working, of course, has been around for decades, but it seems that the pandemic has forced theory into widespread practice. Do you believe it's a structural change that's here to stay, or is it a temporary trend?
Yeah, look, it's a great question, Simone, and one we've been grappling with, I suppose, ever since we were forced to work from home. And it's really the key question around that is the fact that we were forced. I mean, we didn't have much choice, but as you mentioned, working from home and working flexibly is nothing new. I know a number of our own colleagues have been doing so for years without any real negative implications. If anything, it's probably helped their work-life balance, and that's something that I think we've all taken away from this as a positive. But I guess it was a function of, the biggest experiment that we could have all gone through, and working from home, no doubt assisted by technology and the advances that we've been able to enjoy. I mean, if we were 5 years ago trying to go through this, it would have been tremendously different and maybe wouldn't have worked as well. But look, I don't think that wholesale changes structurally are in the works. It's more so at the margin. But when you look around the Australian market at the moment, where there's no restrictions on us going back into the office, yet in Melbourne there's only about 20 to 30% utilisation, and I know in Sydney it's probably closer to 50 or 60. So that suggests, and anecdotally, probably ourselves and speaking to others in corporate jobs and white collar employment, that working from home is something that people want to continue to be able to do. So there's no doubt that there will be a structural element to it as well going forward. But I think we're more concerned at the moment with the cyclical implications of office markets, which is much more important to rents and valuations.
Sure. Let's talk vacancy rates.
Yes.
So currency vacancy rates in Sydney and Melbourne have risen to around 12 to 14% respectively, after a 5-year bull run and record low vacancy rates. Some researchers are predicting the office vacancy rate could be anywhere between 15 to 40% over the next few years, which is a pretty frightening figure. What are your views on those?
First of all, the forecasts going up to a 40% vacancy level is probably way too pessimistic. At the moment, that 12 to 14% level, there's some forecasts out there. Jones Lang LaSalle is our major research provider, and if you have a look at their forecasts, they basically go through each individual building that they work on and measure it floor by floor, and they seem to think that vacancy in Melbourne might peak towards the end of this year at around that same sort of 14-15% level, and in Sydney maybe into next year at just a touch under 14%, which seems a bit more realistic. But look, the structural implications of working from home and the pandemic have had a limited impact on that vacancy level. If anything, it's been more so a function of supply completing over the last couple of years, which was well telegraphed and we all knew was coming, and markets had already factored that in. So, just as some anecdotal evidence, I suppose, all of the pre-committed new supply is at around that 60% level. So new buildings are actually opening their doors with 60% of their floor space leased. And the effects on vacancy more broadly are likely to show themselves in those lower quality assets where those tenants might be moving from. So that's probably the outlook for vacancy there. Unlikely to head into those stratospheric type numbers, certainly in our view.
Yeah. And Mark, what is considered equilibrium?
Yeah, that's a really good question, and it can vary by market, but generally the convention has been in Australia that, between that 7 to 8% vacancy range in markets is where rental growth is stable. And we're obviously, above that, almost 2 times that. So there's no doubt that rental growth is unlikely to come through. Having said that, when we look at the REITs, the vacancy rate across portfolios is at around that 5, 6, 7, 8% level. And as you mentioned, we're coming off a very strong market period, especially in Sydney and Melbourne, where vacancy rates were, 3 and 4%. So there's no doubt there that that's the cyclical impact of the office markets coming through now.
Terrific. So for REIT investors, the all-important rental earnings are absolutely critical. With vacancies rising, at least in the short term, what does this mean for rents and property valuations, which are spoken about all the time?
Yeah, that's basically why we're here and what the most important question is. And I know through last year we saw that the REITs didn't really see that big of an impact on rent collections as well as their earnings and distributions, probably because of REIT landlords having long-term leases to corporate tenants that weren't necessarily stopped from doing business and had to go out of business, but still able to do their work and everything like that. But look, I guess, when it comes to rents and valuations, there's no doubt there's going to be some downward pressure on rents. That's just a fact of the market that we're in. But pleasingly on the valuation side, we've seen values basically hold steady, and indeed that hasn't just been on paper, but transaction levels have actually increased through the pandemic period as we've moved past, the initial stages of the March lockdown.
Which is surprising,
given
what's happening.
Yeah, so that basically tells you that investors in the direct market have taken the view that, we'll be happy to buy these assets for their income, essentially. That's why you buy real estate, commercial in particular. If they're well leased and, there is a case for them being able to maintain their cachet in the market with tenants and their ability to earn rent going forward, even if there is some market rental decline, because, I'm sure as we'll discuss, they've got a really good tenant proposition and they're well leased at the moment. So, across the REIT space, probably think of $2 to $3 billion in transactions that have taken place at or around book values, and they're for really good quality assets in Sydney, Melbourne, other markets that are A-grade space, high quality, with good tenants that are well leased.
That's good to hear. So I'm just thinking back. We've tackled a number of crises in the past. The tech bubble boom, of course, the 2001 terrorist attacks, and of course more recently the global financial crisis. I wonder, is this crisis different?
Look, I think it's different. Certainly everything sort of suggests that given the work from home structural headwinds and the fact that technology's helped us all to do it really well, and maybe it's probably a good thing that employment's been able to be kept relatively high. We had our own unemployment figures released yesterday that were improving, which is great. So that means that the balance of power might be on the workers' side for a change, And if they can work from home a bit more and they want to, and there's benefits to come from that, then work from home could be a bit more accepted going forward. But by no means there's going to be a structural change for everyone working from home. I mean, probably would have gone crazy if that kept going past the 9 months that we had to do it last year, and I know I'm not alone there.
You're definitely not alone.
Exactly right, but I guess also different from the times of the GFC in particular, where it was basically the white collar industries that were most affected, and they saw the most incidents of unemployment and business failure, and tenants were handing back the keys and going out of business and firing workers and getting rid of office space. This time it's almost the opposite. If anything, when we speak to a number of the REITs that own office buildings like the one that we're sitting in now, their tenants have been unaffected by the recession because all of their workers, like us, have been able to work from home just as effectively, and there's been a whole host of government support to help that. That's come through in the white collar employment numbers, as well as business confidence and conditions, and hiring intentions have been pretty strong. So it's not the same backdrop fundamentally from the corporate tenant side. So to that effect, it is definitely, this time it's a little bit different. But traditional office tenants that we speak to, and a lot of our own clients, and a heap of leasing agents have passed on the fact that when they're talking to CEOs, the message overwhelmingly is that if a company wants to be successful in the future, they'll have to be in that corporate setting and working collaboratively and together. You can't schedule spontaneous chat on a deal or an idea over Zoom, and I think everyone's sort of realising that. So that core office space requirement and willingness to be together in an office is going to remain the core about a corporate's identity and what they want to do as a business going forward.
Absolutely, couldn't agree more with that. I guess one of the key differences that comes to mind for me from other crises is just the advancement of technology that we have now. I can't imagine going through the pandemic working from home with even 5 years ago. Certainly not 10 or 15 years ago. But it's such an interesting point about the GFC with the unemployment issues that we're not grappling with today, just perhaps a different way of working going forward. So I'm just looking at worst case scenario. Let's assume that office space does permanently reduce over the long term. But does this necessarily spell disaster for investors? Are there alternative uses for office space that perhaps could be utilised quite effectively?
Look, there's two parts to that question we should probably cover. There's the work from home structural impact and what that means for a tenant that's deciding on whether to have 200 square metres or downsize in their next lease. So for that part of it, I mean, the types of space that a tenant might have occupied might change in its configuration, and that's the message that we're sort of hearing, is that, and I've seen it too, just in our office, people on Zoom calls and we're all in a bank of desks. It's extremely annoying if the person behind you is on a Zoom call and you're working.
Yes.
So to that end, there'll be more need for separate breakout sort of rooms that are, maybe a tech Zoom sort of smaller meeting room. And I know that's the case with a couple of groups I've spoken to. A good friend of mine does office fit outs, and that's what they're seeing at the moment. And that's a trend, and that needs more space. So the quantum of space might not change that much, but the internal configuration might. And that's a bit of an uncertainty, and that's a question that we're just not seeing yet, because that inflection point of a new lease, given the longer dated nature of some of these, hasn't come through yet. And that's something we'll see and we'll watch really closely, and we'll all get a lot more certainty going forward. But I guess there will be assets that are rendered functionally and commercially obsolete as a result of the pandemic and a flight to quality, which is definitely occurring at the moment. So those landlords that are probably in the private space that own assets that are, of age and that haven't been given the same level of TLC and CapEx that makes them, viable to newer tenants. Newer tenant decisions will fall by the wayside unless they're brought up to speed. But we're really fortunate in the REIT space because there's always a focus on portfolio improvement and owning the highest quality assets in the various CBD and metro locations that are typically premium and A-grade constructed buildings that can appeal to tenants' needs for flexibility and the higher quality amenity that goes with it. In terms of repurposing assets, it's probably difficult at the moment. So those tenants, those buildings that are in that first category I mentioned will find it difficult. But as a cyclical asset class, they'll be removed from the market and the space available in a market through any downturn or period of weakness is there's less supply and less construction because the financial returns are less compelling and there might not be as much financing. So the high quality buildings that are traditionally owned by A-REIT landlords are best positioned to weather that.
Yeah, so that's an interesting point.
Yeah.
Just if we can just expand a little bit on, because I see some close similarities with the way we've always described the retail sector. Stark
Yeah, interesting.
differences. You've got retail high strip shopping that is vastly different to your fortress-like experiential large super regional shopping centres. The two you cannot compare. So it sounds like very similar type of assessment for the office sector.
Yeah, look, some similar dynamics, and the word bifurcation is just overused, but it's a good way to think of it, I suppose. Those assets, as I said, that are relatively high quality with good air handling, good services, and the best management teams that can sort of position them to satisfy those tenant needs for flexibility and amenity. And at the end of the day, corporate tenants that realise they have to be in an office to be successful over the longer term, from a corporate perspective, will be happy to spend that time and effort to go into those assets, and the REIT landlords understand that. So as opposed to an asset that perhaps has been managed just for cash flow from a private landlord that might not be as well capitalised or willing to spend the money on increasing that amenity and keeping them current, which as investors we demand that take place, and we go around and see assets to make sure that's the case, will be relatively penalised, and to the extent maybe they are a bit like the strip retail that are maybe losing their competitive advantage.
So Mark, you also touched on supply, which is obviously
Sure.
a critical part of the whole story. Do you think you could just delve into that a little more?
Look, there has been a fair bit of supply in Melbourne and Sydney with new buildings being completed, but as I mentioned, a large component of those have been pre-committed. On the flip side, there's obviously the assets that are the backfill, which is, say, maybe of a lower quality on balance that will have some vacancy. And no doubt that will be an issue. And in Melbourne and Sydney in particular, there is some more supply to come online with some varying levels of pre-commitment. But what we have seen over every office cycle is the fact that there's always changes to that pipeline of new supply as the returns and developers probably get a little bit more realistic with prospects and remove that from pipelines. And JLL data for the most recent first quarter of this year showed that on the last quarter some buildings have been taken out of that pipeline purely because they've been delayed or shelved because they're not as financially viable, and that's essentially the cyclicality of office markets that's coming through there, and that can assist the rental growth prospects and outlook to a degree. So there's that aspect of good financial management, maybe regulating the supply of assets in most markets, and of course We've seen in Brisbane in particular where there have been, relatively higher instances of private developers speculatively building office assets, and that's placed a cap on rents and elevated vacancy for, almost the last decade, whereas in Sydney and Melbourne that's a lot less prevalent, given institutions like the REITs and superannuation funds in particular dominate these markets and basically would never be allowed to do that kind of thing anymore.
Great. So just taking a slightly more detailed look at the portfolio of A-REITs that you manage within the APNA REIT fund, can you share perhaps a couple of examples of office REITs that you're really in favour of at the moment, and those that you're a little more cautious about?
Yeah, look, I think on balance, the office landlords have come through so far relatively okay, given rent collections have been high. They didn't really have too much of an impact on their overall earnings, and valuations have held up relatively well. So book values and NTAs have been relatively stable, if not slightly negative, because of some maybe weaker assumptions in valuations. Definitely given the cyclical impacts on CBD markets from some higher levels of supply, and where in Sydney and Melbourne we've seen some increases in incentives. So that means tenants need more inducement to come into an office building or sign a lease. Whereas, and we're, as you mentioned, we're coming off a period where rents have been pretty high. So at its core, I suppose we've had a look to try and get exposure to those portfolios that have high quality physical assets that are well located, accessible, and are well leased and have high quality tenant covenants around them. And to that end, we've also had a look at, so we're coming through, a cyclically difficult period for corporates, where they're probably not necessarily willing to pay those elevated rents. So rents have to come back, and affordability will be important. So the markets and portfolios that tick all of those boxes for being able to sustain a relatively high income and earnings level and distribution through to our unit holders are those that are relatively biased to metropolitan markets. So there's a number of REITs I can roll off, maybe Growth Point, the Centuria Office REIT, Abacus, as well as the APN Industrial REIT has some office exposure, and they're basically fit for purpose office space that appeals to cost-conscious corporates, and also government tenants that have long lease and WALE coverage over the next couple of years as we sort of move through that flux of how much space needs to be handed back, if any, and how does it need to be reconfigured because of maybe higher instances of flexibility or working from home. That's not to say that we don't have an exposure to CBD office landlords. We're just relatively less probably excited about owning those for their income prospects. The valuations have stacked up and there's been a heap of transaction evidence. But on balance, we think the relatively high risk-adjusted income-based returns are in those that have those attributes. High-quality assets in good locations with good tenant covenants and a lot of government leases are across those assets as well, which is fantastic.
Nice long lease terms.
That's right, and that are of course affordable.
Fantastic. I think then it's probably time to round out the question of why office sector is still a very compelling long-term investment for investors. Could you share your thoughts there?
The office isn't dead. There's no way that we're all going to be working from home and handing back office space. The way it's used will change. And you mentioned commercial property and offices. I mean, it's important to make the distinction that the REITs are relatively well positioned against the generic office owner, which might not be as so. And REIT management teams are absolutely focused on customers and maintaining the income defensiveness of their assets. And we've seen that come through in the results. We're obviously coming off an unprecedented experimental period of working from home and lockdown. And a lot of the the indicators, like I think I mentioned, white collar employment, job ads, and unemployment more generally, as well as confidence. It's basically a confidence thing. People will be coming back into the office, and businesses will see the real benefits of being together and collaborating for the ongoing longevity of their businesses, and that won't fall by the wayside. But there will be some headwinds from working from home, and it could be 5 to 10% of demand. But as I said, the REITs in our space in particular are really well positioned to be able to offer that solution, and probably take a lot of confidence from the fact that rent collections are still really high. Almost back to normal, basically. And people are getting back to the office. I'm sure with the vaccine rollout, and of course some more confidence around not being thrown into lockdown if there's 1 or 2 cases here and there, that'll also help with confidence. And probably the biggest pointer has been actual valuations and transactions that have been printed that show that the investment market is pretty sound for good quality commercial office buildings, and return prospects off the back of that into the medium term in particular.
Mark, thank you so much. That was really insightful.
No problems.
And I guess if I could summarise, I would probably say that it's fair to say that the office party is changing, but it's definitely not over. I guess we certainly recognise that there are headwinds in the short term, but as we see the full extent of this work from home culture, really see how that plays out. But in my mind, and what I'm hearing is that there is no doubt that for successful businesses to prosper, you need an office and a thriving office environment. So all the information that you've provided us today, I think presents a pretty strong investment case. So thank you so much. I hope everyone found that valuable, and we look forward to sharing a lot more information on this very interesting topic over the coming months. Thanks very much for joining us.